Hello, today we're going to go through the Economics Paper 2, May-June 2016 CIE AS paper. This being a data response question means that obviously the approach can be very different to the multiple choice that we've seen. So we're going to be having a look at some of the way we might approach these questions, the best way to go about answering them, and the best way to go on through revision over the next few weeks before the exam. So, this paper's about a policy which Turkey is or has introduced in 2014, the MediumTerm Program. It's got a number of goals: solving the problem of inflation, the current account deficit, and then also implementing some structural reforms. These are very important to increase Turkey's potential growth. They want the inflation rate to fall from the very high 9.4%, considering the UK aims for a 2 plus or minus 1%. However, this being a less economically developed country means that generally the inflation rate is higher as their growth rate is higher. And higher growth usually accompanies higher inflation rates due to the ADAS diagrams. There's also comments in relation to the US economy and seeing how this might affect the Turkish economy. Here we see a graph of the consumer price inflation compared between the period of 2013 and 2014 up to the most recent data that they have. So we can see that the inflation has increased, which means that not only have prices increased, but they've also increased at a faster rate than they did in 2013. Here's the balance of payments position on the current account. We see that there is a large export of goods. However, this is not matched by the import of goods. Services are a net positive, however, not enough to change the balance of current account, balance on the current account, and there's a negative transfer on income, although current transfers are slightly positive. So what happened to the balance on Turkey's current account between the 2 years? Well, it stayed negative on both years. And you can actually write that it increased, so it became even more negative in 2013. This is just a 2 marker, so putting in a single number would be helpful, but not strictly required. Let's have a look what the mark scheme says. Recognition of a deficit in both years, and that this has increased or worsened. 2 marks, very simple. So no numbers are needed, no calculations, although it can be used to illustrate this, the fact that it's getting worse. So using a production possibility curve to show the intended outcome of the structural reforms in Turkey. So if we go back, we're having a look. Okay, so the intentions of the structural reforms are to increase Turkey's potential growth. So let's have a look what that diagram might look like. Here we go. So if we want to draw a PPF, draw axes, we'll label this one capital goods. This one consumer goods. Let's see these axes labels. Let's make that a bit smaller. And then here we can draw our PPF. This is the original position. And then with these structural reforms, we're hoping that the PPF can shift outwards like that. And do we have to do any explanation behind that? Let's see how many marks that they're asking. 2 marks. So same production possibility curve to show the intended outcome of the structural return. So then we can label this curve. We can label this one PPF and PPF1. Okay, so it's abundantly clear to the examiner that we are going from this inner line towards this outer one. So showing a movement of the PPC outwards from the origin, PPC, PPF, same thing, production possibility curve, production possibility frontier, and then that curve is shifting outwards. No explanation is required. You can see that from the wording of the question. They just want you to draw that diagram for 2 marks. With help of a demand and supply diagram, show how the expected change in US interest rates was likely to cause the US dollar to continue to rise. Okay. Okay, demand and supply diagram, expect change in US dollar to rise. Let's have a look. Okay, so here we see it. As the United States recovers, the US central bank is expected to increase interest rates, causing the US dollar to continue to rise. Now, we know that we can always draw exchange rate diagrams on a simple demand and supply diagram, because these are the international money flows which affect exchange rates. Put exchange rates there, and we can label this quantity. And then we can have a supply of US dollar and demand for US dollar. And these are just going to be our traditional curves, which we're very used to seeing. We can label this supply, this demand. And actually, let's be a bit more accurate here. Let's say exchange rate of USD. There we go. And now what we're seeing is we're seeing a rise in interest rates. Now we know due to hot money flows that a rise in interest rates will mean that saving in US banks is more attractive compared to other countries, because the higher the interest rate, the more return you get in the money you put in the bank. So large pension funds and other large money managers will choose to invest money in US banks because that's where they can secure the highest interest rate. To save in US banks, you need US dollars. So a higher interest rate is going to increase demand for US dollars and possibly even decrease supply. Although that might be too much information, let's stick with the more simple case of demand increasing due to hot money flows. Demand shifts from D to D1. I always like to draw a little extra arrow there, just makes the diagram a bit neater, and again makes it so much clearer for the examiner where exactly you're going. And we're seeing a movement from an exchange rate there to an exchange rate here. So this is what we see. We see the US dollar appreciating, getting more and more valuable. Okay. Hello.
Hello, can you hear me?
I can hear you. Yeah, can you hear me too?
Yes. Okay. Yeah, I can hear you.
Oh, okay, fantastic. Let's see if connection's working here. So I've just gone through the first three questions, A, B, and C. To quickly recap, the balance of payments position on the current account has been negative in both years. So been a deficit, and then it's gotten worse. There's that worsening, or it's increased deficit's gotten worse. The PPF has shifted outwards like this. There's an expansion in how much the economy could possibly produce if the MTP is introduced. That's its aim. PPF shifting outwards, and we're seeing now that demand and supply due to hot money flows, US interest rates will cause a rise in US interest rates will cause the US dollar to continue to rise, to appreciate, because of demand and supply for the currency. Are you still with me?
Yep.
Okay, fantastic. So yeah, moving on to question D. Consider whether the outcome of the interest rate change in the US was likely to be harmful for Turkey's economy. Okay, what do you think?
I think it could, because there'd be an outflow of the investment funds,
Yep.
sorry, that would go from Turkey to the US. So that would affect the balance of payments, the financial accounts, and that side of things.
Yes.
The rise in the US dollar would cause the price of Turkey's exports and the imports from the US as well. Both of them affect the balance of payments to get worse.
For Turkey?
For Turkey. So it'll create like a deficit on the current account.
Why would it make exports less? Why would it make exports worse?
Pardon? Like, what do you? I'm sorry.
So explain the reasoning behind that again, behind how it affects the current account for imports and exports.
Okay, so because the rise in the US dollar makes it stronger, right?
Yep.
Then wait, no, actually, it's actually not right if I say the exports get worse off. It's only for the imports that will be a problem.
Yeah, so imports from America are going to become more expensive for Turkey, right? So that's going to affect the consumers in a bad way, because all the things which they import, cars or whatever from America, they're going to become more expensive. However, how could it affect domestic production?
Because then you'll get, oh yeah, it does affect Turkey's exports that way because of cost push inflation. If they import raw materials from the US for production,
then that's going to become more expensive.
Yeah.
Absolutely right.
I lost that point. Yeah.
And are there any ways in which it might not be harmful and which it may be beneficial?
I'm not so sure. I didn't get to that side of things. I forgot.
It's certainly worth considering. So, for example, tourism is going to be much cheaper. So, for American tourists to go to visit Turkey, it's going to be cheaper for them. So, they're more likely to do it. So, it could boost that sector. And also just makes their exports more competitive, except if they have to import raw materials from the US in the first place. Okay. So there's two sides to it. And let's see. So it's got the points there. A number of reasons. Outflow of investment funds, very good. Deficit on Turkey's financial account on the balance of payments. Affect the price of Turk's exports, affecting the current account. Deficit. Okay, that's not very well explained there. Okay, so it's definitely necessary to go into a bit more detail, like we've done, to explain how it's going to affect the current account, because a weakening of the Turkey's currency compared to the US dollar could be very beneficial for exporters. And then you see, then it's going on the other side, the other point of view. The appreciation of dollar would mean that Turkey's exports to the US are cheaper and Turkey's imports from the US are more expensive. And if the Marshall Learning condition is satisfied, this will lead to an improvement in Turkey's balance of payments on the current account and possibly a fall in employment in Turkey. Okay? So to get all the marks, you have to look at harmful and the beneficial effects of the interest rate changes.
Yeah.
Okay.
Yep.
What do you know about the Marshall Learner condition?
That once it's like, I don't know how to explain it, but if it's like, I don't know. If I can't explain it properly, I don't know it well enough.
That's what Einstein always said, isn't it? If you can't explain it to a 10-year-old, then you don't understand it. Okay, so yes, other things. So it's certainly something to do with macroeconomics and exchange between nations. So it's about elasticity, right?
Okay.
So if we see any depreciation on, of the exchange rate of any currency, that's only going to lead to a net improvement in the trade balance. Usually a depreciation would improve our trade balance, right? Would improve our current account position because we're going to be exporting more and importing less. That's only going to happen if the sum of the price elasticities of demand for exports and imports is greater than 1. Okay? Can we think why that might be the case?
If the sorry, I lost my train of thought.
No worries. So think about this. Let's think about a really inelastic good, okay?
Okay.
So your country, we are Turkey. We import things like steel and we export things like oil, okay? Both of those are rather inelastic goods, okay?
Yeah.
So, and this is our demand curve for steel, and our demand curve for oil, which we export, is very similar. So now our currency depreciates. Usually that's kind of a positive effect on our current account position, right?
Yeah. This time.
However, let's think about it like this, right? So, okay, we're selling this much steel in the beginning. Then suddenly our currency depreciates, which lowers the price for international consumers, but they only buy a tiny bit more, okay?
Yeah.
So the total value in another currency, so total value in US dollars of how much oil we sell has actually gone down. Okay?
Yep.
At the same time, for imports, we import steel. That gets more expensive, but we still buy as much. We still import loads and loads of steel. So the total value of steel imports has actually gone up. So this depreciation on the current account, the depreciation in the currency has actually meant that our country is actually importing even more value-wise and exporting even less value-wise, which has meant that our current account position has gotten worse. Okay?
Makes sense, yeah.
However, under the Marshall-Lerner condition, so when the sum of the price elasticities of demand is greater than 1, so for example, let's say this one is 0.4, and this is, I don't know, 0.3, that sums up, and this is obviously negative, right? We usually leave off the negative sign when we're talking about elasticity of demand anyway. That sums to 0.7. So a fall in the currency is going to worsen the trade balance. If, however, they were, like, I don't know, 1.4, for example, and 0.3, then I'd sum up to 1.7. That would improve our current account. Okay? If they sum to exactly 1, then it leaves the trade balance unchanged.
Okay.
And so this is the price elasticity of demand for all exports and imports, so kind of an average figure. That's what the Marshall-Lerner condition is about. That ties in quite closely with the J curve, which I think we've covered before. Do you remember what the J curve is?
Yeah.
What is the J curve? How does that work? I can't hear you. Okay, possibly the signal's cut off. Okay, I'll just quickly explain the J curve, and if you already understand it, this is good revision for you anyway. So J curve basically makes the assumption that the goods, imports and exports. Oh, yeah, you're coming back. Okay, can you hear me?
Hello, can you hear me?
Yeah, sorry, the signal cuts out.
Yeah. No worries.
Okay, I'll just quickly explain it. And then it's good revision if you understand it already. So basically, the J curve makes the assumption that imports and exports are inelastic in the short run and get more elastic in terms of their price elasticity of demand. So that's because, for example, a lot of big companies will have long-term contracts with other countries or other companies where they're trading with. So if there's a small change in exchange rate, then they can't immediately, start buying their steel from somewhere else instead of buying it from the US. Whereas if they have more time to do it, if there's a long-term change in the exchange rate, then they'll have time to adjust their position. So the J curve says, you know what, in the beginning, the Marshall-Lerner condition will not hold because both imports and exports are very inelastic. However, as we get more time, we become more price elastic. So first, there's going to be a worsening when there's an appreciation, but given time, the current account position will improve drastically. That's that J curve, and that is exactly flipped if we're talking about goods. If we're talking about an appreciation in the exchange rate, then it would look, oh no, not exactly. No, it'd be an upside down tick. So improving first and then getting worse. Okay, that's the J curve.
And that's because over in the long run, the demand for a certain good becomes elastic, correct?
Exactly right. It becomes easier to find substitutes, which is going to increase elasticity. Long-term contracts, less of an issue. All these kind of things. Okay. So, explain 2 factors that determine how the increase in consumer prices between 2013 and 2014 might affect the total value of Turkey's exports. Okay, well, guess what we can mention here? What do you think?
The price elasticity of demand for Turkey's
Definitely.
exports.
Yep. So how would you explain that factor a bit more?
So if the demand is price inelastic, then the total value of Turkey's exports will increase. But if the demand is price elastic, sorry, then the total value will fall. Furthermore, in the long run, the demand is likely to be elastic, therefore it will fall in the longer run.
Very good. Yeah, so you can talk about the J curve and the Marshall Lerner condition in one go. Let's see what the answer sheet says. Price elasticity, very good. Inelastic, then total value will rise. If it's elastic, then total value will fall. More elastic in the long run. Second factor is Turkey's rate of inflation compared to inflation competitors. Another point there. And you don't know what the exchange rate is in other countries, so that's going to affect, their position there too. And offsetting change in Turkey's exchange rate. So, for example, if the exchange rate fell drastically, then that could offset the inflation, and whether that's been affected by the price of internationally traded goods, cost push inflation. So yeah, very good there. Okay, discuss how.
Four if I mentioned mine.
Would what, sir?
For my answer, would I get 4? Because I'm not sure if I might get 4 because they kind of seem similar.
So I guess what you've done is you've talked about elasticity and then the time frame on which it would work.
Okay.
One factor is demand is like in the long run. Okay, a second factor. No, I think you'd only get a maximum up to 3 marks there. Because the points are too similar. For these questions, when it's explained 2 factors, I always think it's worth doing 3. You've got nothing to lose, and they always mark the best 2. So if one of them doesn't really count, then they'll just mark.
Okay. Yeah. I thought it might give a negative thing because it's like the student can't read the question.
No. If it's asked, you always do 3.
Okay. Thank you for that.
No worries. And okay, so discuss how tight fiscal policy can be expected. Sorry, do you understand how all the other factors work? Offsetting?
Yes, I do.
Okay. Discuss how tight fiscal policy can be expected to help Turkey achieve the first priority of the MTP. So the first priority of the MTP is lowering inflation, if I remember correctly. Let's have a look. First priority is solving the problem of inflation. He wants to lower it from 9.4 to 6.3. So discuss how the tight fiscal policy can be expected to help Turkey. What graph could you draw for this? Okay, I think the signal's cutting out again. I'll draw the graph and see if it comes back.
Aggregate demand shifts to the left.
Okay, oh yeah, you're back. Good. Aggregate demand shifts to the left. Why? How do we know this?
Because fiscal policy is tax rises and government spending cuts.
Very good. So what components of aggregate demand is that going to affect?
What components of aggregate demand?
Aggregate demand.
I'm lost. What do you mean by what components? Oh, the consumer expenditure and the government expenditure.
Very good. So that's those 4 are the components of aggregate demand, and those are the 2 that are affected. Shifting 80 to the left, and this puts downwards pressure on prices, doesn't it?
Yeah.
Does that mean that prices will necessarily fall? Are we going to have deflation?
No, it's just disinflation. No. Inflation would reduce.
Very good. And
would I get extra marks if I defined what a tight fiscal policy is? Which is like budget surplus or reduction in budget deficit.
I think there are definitely marks for definitions. Let's quickly finish these axes labeled. Okay. Let's see how the question is phrased. So discuss how tight fiscal policy can be expected to help Turkey achieve. Okay, so it's a 6 marker, which means they'll probably give you 2 or 3 marks for a diagram, 1 or 2 marks for definitions, and then up to 4 marks for making good points. So basically, you want to throw everything you've got at it, right? So how would you define tight fiscal policy? Spending less and taxing more?
Yeah, government spending less
taxing more, and that it's meant to help with a budget surplus or reduction in the budget deficit.
Okay, very good. And then you draw that diagram. You could draw Keynesian, neoclassical, either one, and you could show the downwards pressure on inflation, right? Now, how effective is this likely to be?
How effective? So,
in the short run, so there's tax rises. It would be effective because it reduces all that, but in the long run, it's not effective because it might cause cost push inflation.
Very good.
With tax rises, because then labor would want higher wages.
Okay.
So cost push inflation. It's also, there's a high opportunity cost because there's less government spending, then it's less likely to be spent on like productivity.
Yeah, I mean, a lot of government
so, like,
spending
education and things.
Research, education, infrastructure, repairing potholes, that kind of stuff. If the government doesn't spend on it, then that's going to impair the country's future possibility to make stuff, right?
Yeah.
Okay, so how effective is it going to be? So kind of effective in the short run, but if it happens, if
in
it
the
stays
short run, it would be quite effective, but in the longer run, no.
Okay, and what else does it depend on? It depends on how big is the government already. For example, if the government only spends a tiny bit, then that's not going to affect it anymore.
Okay.
And how much tighter the fiscal policy is. It's just the how much kind of questions. Like what kind of scale are we talking about? They're very, very important as well. Let's
and
have
possibly what's causing that inflation.
Yeah, possibly what's causing that inflation as well. If it's
like cost push or something.
Yeah, if it's cost push inflation, then you're not gonna solve it as well by reducing demand, and certainly not in the long run. Sorry. So let's have a look. Let's have a look at what the mark scheme's saying. So yeah, so understanding fiscal policy. There you go. That's your mark for defining that. For an example of what is meant by tight fiscal policy, i.e. an increase in taxation or a decrease in government expenditure, or a budget surplus, reduced budget deficit, you get 2 marks there. For clear explanation of the way in which tight fiscal policy might encode inflation, so that's drawing the diagram, talking it through, so saying reduction in aggregate demand, shifting the AD curve to the left, which would reduce pressure on prices, as we see shown on the diagram here. And then talking about the effectiveness of the actual policy. So would the government be able to implement it? Is there a lot of resistance to it? Could it mean that they get voted out of office? And then talking about cost push pressures, very good. And then coming up with an evaluative judgment, something like it would work quite well in the short run, but it could be very negative in the long run. I think you answered that quite well. Happy? Adarsh? Okay, I'm assuming the signal's off again, so let's just continue. Okay. So now we're moving on to section B, where we're expected to answer 1 question, so first an 8 marker and then a 12 marker. We get 3 options, and all 3 of these are very, very standard essays we're seeing this week. So, explain the meaning of price elasticity of demand and the facts that change the demand for a good to be elastic or inelastic, or something to do with private goods, public goods, that kind of all very standard essays. Adarsh, are you back? Not yet. Okay. Hello, can you hear me?
Yeah, I can.
Okay. So just a brief aside, before we move on to the more macro kind of thing, I had a look at the official mark scheme for the question we were stuck on last week, and so question 15 ended up being removed from the entire paper, because it was seen. Sorry. Yeah, no, well, I mean, this was the it wasn't on the mark scheme that we had, because that was the marking which the examiners used. Then, after lots of examiners complained that the question was unreasonable, they removed the entire question because it's not stuff which we see on the syllabus. So that's fine there. In terms of the policy trilemma stuff, we'll have a quick look at how that might work. So, basically, there's this. I mean, a lot of people say that this is the whole of macroeconomics. This is the most important thing that we actually see in macroeconomics, and you can make some very interesting points about it in essays as well. So there's this trilemma you have to make. So you have to make a decision. There's a trade-off between either having autonomous monetary policy, basically, so being able to set interest rates, having autonomous exchange rates, so being able to set your own exchange rates in terms of how much your currency is valued to other currencies, or having free capital flows, so being able to allow money to move freely in and out of your country. And you can't have all three. So, for example, if you're pegged to the US dollar, so for example, Hong Kong is pegged to the US dollar, which means it's got exchange rates are fixed. If it also wants capital to be able to move freely in and out of the country, then it's going to have to let its interest rates move around, and they can't move around based on international pressures, and they cannot let that be set autonomously, because if they try to, then for example, if the US dollar appreciated, then their currency would have to appreciate. But if they also try to raise interest rates, then that would mean that more money, hot money, flowed into Hong Kong, and that would cause the exchange rates to rise, so it'd break the peg with the US dollar. So there's no way that you can have all three of these at the same time, unless, of course, you restrict capital. So if they said, only this amount of money can come in and out of the economy at a fixed amount of time, and they're keeping that balance, for example, that's what China does, then you could operate at this point here. So companies like China operate here. I'm not going to bother writing that out. China operates there. Places like the United Kingdom have an autonomous interest rate and have free capital. So, for example, the US and rich countries there. And we see in the past, so for example, in the EU, the countries have a fixed currency, so their exchange rates are all pegged together, and they have free movement of capital, but that means that they cannot set their own interest rates, which was what was so significant in the run-up to the 2008 financial crisis, where Greece was pegged in a sense because they had the same currency to Germany, which meant that Greek borrowing costs were far too low. Those couldn't rise, causing excess amounts of debts to be accumulated, and then that meant that interest rates couldn't be lowered enough once the financial crisis had started. So there's this fundamental trilemma. You have to choose between being on any one of these three sides, and you can't actually have a balance. You can't have all three, and it's up to the country to decide where they're going to operate. Can you hear this, Adarsh?
Yep, I can.
Awesome. Okay, so moving on to section B, some more micro kind of stuff here, although there's a macro question here. Which question did you decide to answer?
We already did 2, which is private and public goods. We did 3 as well, so I took 4 because that's like my worst thing. We haven't really done monetary and supply side that much compared to the other 2.
Very, very brave. Yep. Okay, so then a bit more macro kind of stuff. How do you feel about the policy trilemma? It's very annoying. The signal seems to cut out every time you start talking. Okay, no, I can't hear you at the moment. Let's start having a look at question 4 and hope that you can join us in a moment. Okay, so using examples, explain the instruments of monetary policy and supply side policy. Okay. Okay, I've just seen your message. Very good. Okay, so let's have a look at the instruments behind monetary policy and those of supply side policy. So the three main types of government intervention, government policy that we see are fiscal, monetary, and supply side. So we already mentioned fiscal. You know, that's taxation policy and government spending policy. Monetary policy is about interest rates and the money supply. Also, we're now seeing some more interesting kind of manifestations of monetary policy in quantitative easing, or suggestions which some economists have looked into, such as helicopter money. And these can also be seen as forms of money supply controlling, or certainly within monetary policy. Then on the other side, we get supply side policy. So that's still government spending. So parts of it come under fiscal policy because it's the government investing into education, it's funding research, it's creating more competition in the market. This kind of stuff is supply side policy because it's aimed at, in the long run, increasing our PPF, basically shifting our PPF out, increasing the amount that the economy can produce on the supply side of things. Okay, so some of the instruments behind them. Let's have a look at monetary policy first. So how would the instruments of monetary policy work? Well, let's have a look at interest rates. So interest rates are set in the UK, certainly by the central bank, the Bank of England, and dictated by the Monetary Policy Committee, who meet, I think, every 2 weeks to decide on how the future of the interest rate should progress. And this is they aim to target an inflation rate of 2%, and that's how they keep adjusting their interest rates. So how does this work as an instrument? Well, when interest rates rise, that makes the opportunity cost of spending higher as well, because consumers have to make the decision between saving or spending their money. And if interest rates are high and they can go to the bank and save their money in the bank, then that would mean that if they choose to spend instead, then they're losing out on even more money. They're losing out on all the interest they could be earning. So we have empirical and theoretical evidence to suggest that the higher the interest rates, the less likely people are willing to spend. They see, oh, you know what, if I save for a year, then I'll have even more money to buy even more stuff next year. At the same time, a higher interest rate means that borrowing costs are more expensive. So we see a lot of the consumers in the UK have mortgages, for example. And if they're on variable rate mortgages, then a higher interest rate is going to mean they end up paying more to the bank. That will leave them with less disposable income to spend on spending, because they have to, you know, they're paying more on their mortgage, and that's going to reduce or contract the amount which they can spend there. Things like credit card, the APR on credit card is going to rise as well, because basically the central bank interest rate gets passed along to high street banks. The interest rate is at a most fundamental level. It's the rate at which high street banks can borrow from the central bank. And if high street banks can borrow from the central bank at very low rates, then competition will mean that these are passed on to consumers. If that rises, once again, competition will mean that this is passed on to consumers as well, but with a spread. So just because, you know, the interest rate at the moment is 0.5% from the central bank doesn't mean that anyone has a mortgage of 0.5%, because while banks are pretty much, or for a long time were assumed to be riskless, people are risky. So banks have to take into account that risk and also have to make a profit. So it's a spread between the central bank interest rates and the high street interest rates that we see on things like credit cards and on our mortgages. On the other side of things, we're looking at firms as well. So firms don't often have large amounts of money sitting around in their balance sheets, which means if they want to fund investment, then that has to come from borrowing. If the cost of borrowing rises, then that pushes more investment into territory which makes it not worth it. So if borrowing rates are, close to zero, if it costs, 1% for a company to borrow money and build a factory, then the chance of that factory being profitable for the company are very high. If, however, any money that the company borrows today is charged at 10%, 20%, 30%, whatever, then the cost of that factory actually increases, which means that the chance of it returning money and being profitable for the company are lower, so less investment takes place. This is reduction in I, also reduction in C, and this causes AD overall to fall, causing that lower inflation rate. That's one of the channels to which interest rates can work. Another instrument of monetary policy, we can look at something like quantitative easing or even the money supply. So quantitative easing is printing money, basically printing electronic money. There's no printing presses involved, and using it to buy up liquid assets, usually bonds, from the market. So that will basically push bond interest rates down, because we're going to get a bit more technical here, but it's definitely worth having an explanation of how this works. So if we're thinking of a bond, there is the amount which the company borrowed. Let's say the company borrowed £1,000, and next year, they're gonna pay you back £1,200. So this is a bond which you loan £1,000 to the company, and then at the end you'll get £1,200. So if this is a 1-year bond, then the interest rate here is 20%, and this comes in one big lump sum bullet repayment. This is one type of zero coupon bond, we call this, because there are no amortization, there's no intermediary payments between. So once this has been issued, the price of this bond fluctuates on the market. So we know that the yield on this bond is 20%, because we've bought it for 1,000 and we're getting £200. So that's a yield of 20%. However, this is going to get traded on the market, and due to the systemic risk of the company, due to the demand and supply of bonds in general, this price is going to change. So this is going to have a constant price. For example, at one point in time, it could be worth £800 because everyone thinks the company's going to go bankrupt. So actually, the price of this bond falls. No one wants to hold the bonds of a company that's going to go bankrupt, because they're not going to get their money back. So if the bond falls to £800, well, then you can buy for £800, and you can still hope you're going to get your return of 1,200 at the end. But if the company goes bankrupt, you're not going to receive that. So the yield on this bond is increased. The interest rate on this bond is increased because you're buying it for 800, hoping to get a return of 1,200. That means a yield of 400 on 800, so a yield of 50%. So what happened is this bond started with a yield of 20%, but now it's increased to 50% because the worth of this bond has gone down. Okay? So the interest rate, the cost of borrowing for this company has risen from 20 to 50%. Okay. Now let's draw this out on our on a demand and supply diagram. There is simply supply of bonds and demand for bonds, and this is going to happen across the whole economy. We just can easily just draw this out on a demand and supply diagram. If suddenly the Bank of England, this is price of bonds, this is quantity of bonds. If the Bank of England suddenly starts buying bonds, corporate bonds and government bonds, corporate bonds are bonds issued by companies, and so in the UK we talk about gilts, GILTS. Those are bonds issued by the UK government in order to fund the budget deficit. If we start buying those up, if the central bank starts buying this up, that radically increases demand for these bonds. What does that happen? What happens to the price of bonds? Well, the price of bonds increases, doesn't it? Which means that the face value, 1,000, stays the same, but the trading value actually increases. So, it could increase to 1,150, for example. There's more demand for the bond. Now that this traded value is increased, that means that people who buy this bond are only, and still they're still only going to get 1,200 at the end. That's how much the company pays the holder of the bond at the end. That means that they only get £50 on top of how much they bought it for. So £50 over 1150, 50 divided by 1150, let's quickly do the maths here, means that the interest rate is now only 4.3%. So by buying up bonds, we push down the interest rate. If the interest rate is lower, that means that the cost of borrowing for companies is lower. So more companies are going to borrow. It becomes cheaper. Investment becomes more worthwhile. If it's cheaper to go into the capital markets and borrow money, more companies are going to do it. So quantitative easing, this kind of exciting alternative monetary policy used widely in Japan, used in the UK, used in the US, and it's only been used in this last session. So how well it works is still under debate, but more and more papers now being published which say, actually, you know what, it works really well in terms of lowering interest rates. However, there are some issues with it as well. So, for example, you're buying bonds from people who hold bonds, which are usually kind of rich asset managers and large hedge funds who hold a lot of these bonds. So they're getting richer and richer. But this is in the middle of a recession. So there's a financial crisis going on, and the government's printing money, but instead of giving it to the people who need it most, those who've become employed and stuff, they're just increasing the value of assets for, you know, large asset management holders and things like that. So there's still questions about equity and equality which need to be answered when we're discussing quantitative easing. Okay, let's have a look at what else this question would like us to go into. So an instrument of supply side policy. There's a number of ways in which through supply side policy could work. So investment in education by making factors more mobile, for example. So if we have a better education system, then that might mean that people who become unemployed in one sector can more easily move to another sector. Why might this be the case? Well, if you have a better education system, then everyone learns more maths, everyone learns more English. So whether there's a structural unemployment in journalism in the UK because of the advent of the internet, pushing down earnings in journalism, well, everyone has higher education levels, so everyone's better at maths, which means that no one's stuck in journalism. So these people can easily move into more mathematically rigorous subjects, mathematically rigorous places to work, such as maybe something in engineering or accounting. So a better educated workforce is more mobile. There's a higher degree of labor factor mobility. And this means that less time spent unemployed, which can reduce our output gap. At the same time, higher levels of education mean that people are capable of producing more. So certainly this is true in things like training. Why are apprenticeships so valued at the moment in the UK? And why is there so much push to get more young people into them? Well, because apprenticeships actually give people the skills in order to compete and to take part in the labor markets much more effectively than they did before, and so produce more. This shifts out our PPF. So again, we see this outward shift of the PPF because of this investment in education and training. So at the same time, we see PPF shifting out, but also the output gap is decreasing. So this is the output gap before. The output gap is actually smaller than it was before. So we're getting a massive increase in the amount supplied. Our economy grows hugely when we invest in the supply side. Of course, you know, there are going to be some issues with it. You know, nothing's perfect. Sounds a bit too good to be true. Well, it's very expensive. It takes a long time. And how long does it take for a better economics A-level syllabus to actually have an effect on the workforce? Well, you know, it takes a couple of years for it to be written, then a couple of years for it to be taught, a couple of years for the kids who have now been taught it to exit the system and graduate from university. So by the time that these people are actually in the workforce, it's been 10 years. And this is also very expensive, and their efficacy is often debated. So there are questions as to whether, you know, they actually work. Is a more rigorous economics A-level syllabus actually the best way to spend UK government funds in terms of increasing the supply side? Or instead, should we be investing in more roads, for example, another supply side policy? So there's very, very big debates about where this government's funding should go. And then there's people at the same time saying, okay, this is all great, increase the supply side, but the UK government doesn't have money to do this. We're running a large budget deficit. Our debt as a percentage of GDP has increased every year for the last 10 years. But to counter that, there's this argument that Gordon Brown made of this golden rule that budget deficits are okay. So the government spending more money than they get in receipts and tax receipts is all right, as long as this spending goes to investments. So investing in increasing supply in the long run, because that will mean more tax receipts, more higher wages, more employment, so higher tax receipts in the long run, which will easily pay back that budget deficit. The problem comes when the government spends money on transfers, for example, higher pensions or more to the NHS in terms of higher salaries for doctors, because these impair the government's ability to meet their fiscal position, so to achieve a balanced budget, but also do not invest in increasing the long-term output of the economy in the same way as supply side policies might do. Okay, let's have a look what the exam scheme says about some examples. So we go straight to question 4 here. Okay. So then they're giving us 2 marks for knowledge and understanding. So that's just simply explaining it, defining it, possibly drawing a diagram. Then an application of how these might be used in an economy. So for example, lowering interest rates to act as an expansionary policy, to increase demand, to boost inflation, to lower unemployment, to grow the economy, something like that. Then they're offering another 2 marks for a knowledge and understanding of supply side policy. So talk about education and training, talk about building more roads, talk about HS2, anything you want there, and then an application again. And that'll bring you up to those 8 marks. So it's very, very simple question here if you understand the differences between the two. Money supply, interest rates, exchange rates, credit regulation, goods and services, reduction in taxes, increased supply, training of labor, enhancing skills, relocation grant. So this is about mobility of labor. Factor mobility is so important on the supply side of things. Okay, now let's consider part B here. Okay, so discuss the advantages and disadvantages of supply side policy and consider its effectiveness in an economy that is facing a labor shortage. Okay, so a labor shortage. That's going to push up wages, make it more expensive for companies, because a smaller pool of available labor, a smaller pool of unemployed people, means that workers have higher bargaining power because, oh, if you don't pay me a higher wage, I'm going to go work for your competitor, and there's no one else which you can hire instead because there's a labor shortage. So workers will demand higher wages. This pushes costs onto companies, which forces them to raise the price of their goods, and that causes some degree of inflation. So this can be seen as a bad thing. How effective is supply side policy going to be? Well, that certainly depends on what supply side policy we're going to go for and how it's implemented. So that's where your evaluation is going to come in. So the approach you take is probably look at 2 different supply side policies, really go into a lot of detail about how they'd work in this specific case, and then actually evaluate and consider how effective they're going to be, how much money they're going to cost. Are there some problems with doing it? Is there a chance of government failure, for example? And that'd be the best way to approach this essay. So if you have a look at what the mark scheme says before we go into some detail, it's all about defining it. So, increasing aggregate supply, non-inflationary growth, along with productivity. However, there's an opportunity cost, it's super expensive, and the fact that many of the improvements take a long time to take effect. then you're going to get 6 marks for analysis, 4 marks for advantages, 4 marks for the disadvantages, up to a maximum of 6. And then the last 4 marks are purely evaluation. So how effective is it actually going to be? That's what we're going to look at right now. So let's say we're discussing education and training. How effective is that going to be? Well, is it going to reduce the labor shortage? Certainly not, unless of course it causes higher levels of immigration, because a better education system would encourage more people from other countries to move to the UK. That could, in one sense, combat the labor shortage. But if people are able to be more productive, able to produce more, then that's also going to combat that labor shortage within itself. The same number of people producing more is the same thing as keeping everyone at the same productivity level and just having more people. So some evaluation to do with how long it takes, so long run, short run, for different types. So for example, training, apprenticeships, they're much quicker than improving primary education, for example, because apprenticeships happen when people are 18, compared to primary school education is obviously when people are much younger. So you could talk about, in what time frame were we seeking to operate? Is there a way that we could target? So you can target supply side policy to specific areas of the nation, which is one of the advantages. For example, interest rates are just set nationally, right? So you have a lower interest rate. Well, that's gonna be expansionary in the whole country. It's going to be expansionary up in the north and the south. Supply side policies, you have much more room to target it specifically on where you want to target. So if you're interested in the northern powerhouse, this idea of which the current Conservative government is very big on, increasing the wealth and prosperity of the north, then you're going to want to target that supply side policies, education and training more on the schools based in the north of the country, and you can do that with supply side policies. That's certainly one of the advantages. Another bit of evaluation that you could come in with on the disadvantages side is, well, there's this idea of brain drain, right? So for example, you educate everyone, you spend a lot of money on them, but then the UK isn't growing very quickly. So instead they're going to move to countries where it's growing much faster. So they might go to India or China and use all the education that they've learned on UK taxpayers' money and go increase the GDP of countries like China and India. 4 marks for this evaluation, and then I'd always end with a concluding sentence, so a finishing sort of evaluative comment where it says something like, supply side policy can be effective as long as it is targeted in the long run, and there is enough political capital behind it in order that's going to be continued. Because often what we'll see one government come in with these long-term ambitious plans, they'll get voted out of office, and then the new government will have no interest in continuing it, and all the supply side effects are diminished by that. So we need enough kind of bipartisan, so across both parties, support for these policies in order that they'll work in the longer run. Okay, so we've already gone through these first 2 questions. We're not going to repeat those again. Yeah, thank you very much for tuning in, and see you next week.